ETF complex is buying roughly 3 times the number of Bitcoin that are mined. So we got the halving socks on today, and that's only for the next 3 months. 3 months from now, that number goes from 900 to 450. If the same pace keeps up, which I think is pretty likely, you're going to be talking 6 times the daily production. And so
Hi there, lovers of cryptocurrency. We are excited to have renowned investor Mark Yusko on board for this insightful video, as he sheds light on the state of the cryptocurrency market right now. Yusko contradicts the widely held notion that the exchange-traded fund, ETF, is the key driver of the expected rise to 6-figure Bitcoin pricing as the cryptocurrency remains stable at $42,915. As to Yusko's insightful assessments, an unparalleled wave of market madness is about to occur due to the coming halving event and institutional investors' active strengthening of their inventory. Yusko creates an image of impending chaos that makes investors fearful of missing out, FOMO. But in typical market manner, Yusko sees an eventual correction coming after this uptrend. As we eagerly anticipate Mark Yusko's insights, it's crucial to stay tuned and consider the implications of these market dynamics. The cryptocurrency landscape is evolving, and Yusko's predictions offer valuable perspectives for investors navigating this complex terrain. Before we dive into Yusko's compelling analysis, don't forget to subscribe to our channel and hit that notification bell. By doing so, you'll stay updated on the latest interviews, expert analyses, and market trends in the world of cryptocurrency. Without further ado, let's hear Mark Yusko's perspective on the fascinating trends that will influence both Bitcoin's and the cryptocurrency market's future.
Look, the short term is clearly, to me, irrelevant in the sense that what happens in these events is the big dogs manipulate in the short run, right? They know that they can buy up assets in advance, they can then short against it, and they do all kinds of arbitrage. And ETF arbitrage is why Ken Griffin and others like him are so wealthy, right? I mean, they benefit, the market makers benefit extraordinarily, and the prop trading desks on Wall Street and all these people scalp, shall we say. All of this, it's like when you think you're trading for free on Robinhood, you're just not, right? You're paying way more than the old days of high commission rates, in the sense of you're losing on execution and your order flow is being sold to the rich guys. And then if you watch the movie, which is a great movie, I mean, it was so good. Dumb Money was just so good. They can just turn it off. Front running isn't what bothers me. What bothers me is the spread. You think when you put in a market order, again, you're not getting a good fill, right? It's just, there's a very wide spread in the bowels of the trading. And it's fine, right? I mean, look, anything that's free, right? Facebook is free, but you're paying for it in the sense of, I mean, not directly, like it's not money out of your pocket, but you are the product. So lots of things that are free that aren't free. The idea that all of the money, right? We've talked about all the different estimates from, 30 billion if, investors, that the captive investor base in these brokerage firms that haven't been allowed to participate, is roughly 30 trillion, pick a number, and 0.1% would be 30 billion. And that would move the market. And we've seen about a third of that. We've seen a little over 10 kind of come this way, but it doesn't happen in day one. And it gets, I would argue that 0.1 is even kind of a silly number. I think it's easily going to be 1%. So that's 300 billion. But what we saw was a bunch of the big guys said, oh, no. Even though this is a BlackRock or Fidelity approved ETF, we're still not going to let you buy it with your money. So people said, well, I'm out, right? I'll just leave and go someplace else. But eventually, I think they're going to change their minds, and that money will continue in right now, every day. And we'll see how long it lasts. But I think it's going to last for a while. Every day, the ETF complex is buying roughly 3 times the number of Bitcoin that are mined. So we got the halving socks on today, and that's only for the next 3 months. 3 months from now, that number goes from 900 to 450. If the same pace keeps up, which I think is pretty likely, you're going to be talking 6 times the daily production. And so that is a supply-demand imbalance that will lead to rising prices. And I mean, people have heard this from me ad nauseum. Rising prices beget rising prices, right? Once an asset starts to move, people are drawn to it. That's the way it works. And that will push us past fair value into, silly levels sometime in the crypto fall that'll start, next June. And a year from now, I think we'll be talking about, oh my gosh, how did we get to triple digit Bitcoin? And when's the bear market coming? Because there will be another bear market, because the FOMO gets really extreme as you start to go parabolic in any asset, like NVIDIA right now. I mean, Tesla before, NVIDIA right now it's amazing to watch.
Mark Yusko offers a sophisticated analysis of the cryptocurrency business, casting doubt on the importance of transient market swings and exposing the dishonest tactics used by big participants. He outlines strategic maneuvers such as buying up assets, shorting against them, and engaging in ETF arbitrage, highlighting the hidden costs associated with seemingly free trading platforms like Robinhood. Yusko's estimate goes further, predicting billions of dollars of captive investor capital that is just waiting to be released into the market within brokerage companies. He sees a change in institutional thinking in which these companies will ultimately let their capital to go into authorized ETFs, resulting in a steady inflow of money. As of right now, the ETF complex is acquiring 3 times as much Bitcoin every day as is being newly created, resulting in a clear supply-demand imbalance that will likely push prices higher. Yusko projects that daily Bitcoin acquisition by ETFs will climb 6-fold in the future, pushing prices to what he refers to as silly levels. It is anticipated that this imbalance will lead to a price spike fueled by FOMO, which will ultimately result in another bear market. All things considered, Mark Yusko's observations offer a thorough grasp of market dynamics, highlighting the significance of a long-term viewpoint, institutional changes, and the possibility of substantial price swings in the cryptocurrency market. But that's not all. Let's hear what he has to say next.
We have now more passive money than active in the United States. What does that mean? We have more index funds and ETFs. Passive. Now, passive, by the way, is not passive. I tweeted this out the other day. In the last 20 years, only 31% of companies that went public still exist. Think about that number. 69% of them gone. So there is turnover in these indices. It's just slow. But what they are capitalization weighted, meaning they have to buy more of things as they become expensive. So they get more and more and more concentrated. And we saw this phenomenon in 2000, and you get to a point where silliness, right? Cisco at 286 times earnings, and people finally wake up and say, "Ooh, that's bad." And you have a correction. And here we are again. And you got all these companies now trading 100, 150 times earnings, 30, 40 times revenues. And people are like, no, it's different this time. 4 most dangerous words in investing. And it will end. But when people try to short it, and we've talked about this before with MicroStrategy in 2000, you can try to short the stupidity. And MicroStrategy in 2000 is very different than NVIDIA. It's more like Cisco and Microsoft to NVIDIA. Perfectly good. Or Intel. Intel went up 20-fold. Think about that. It went up 20-fold in 4 years because it was going to change the world with AI. It's funny, back in 2000, they were talking about AI. And now it's down 40% since then. So, because it got, displaced. And I saw the CEO of NVIDIA on the other day talking about, the entire structure of computing is changing, and we're leading that. And this is great. I love people who are humble braggers. I mean, he's very soft-spoken, and we're the only company that gets this. Really? You think you're the only company in the world that gets that we're in a transformational move in computing? Okay, fine. I have a few companies that would disagree with that. But if you short that in a momentum world, you get knocked down. So totally agree with you. And actually, we have data on this. So the volatility, it's from this side. Volatility is trending down it's reversed on my screen. I can't do it. It's confusing my brain. But volatility Bitcoin was triple digits when it started because it was a science project. There was no there. It was super vol, a little penny to 2 pennies. That's a 100% move. But as it has gotten more mature and gotten bigger, that volatility is now trended down. It's like in the 40s, long-term still closer to 65, 70. but we're definitely going to trend down. And it's because the passive holders, hodlers are part of that, but now the ETF is structurally a passive holder. Leverage is also down. So there's not as much leverage and as much speculation. There will be more leverage. Leverage will come back, but there's not as much as there was. So I don't disagree with that at all. But the passive versus active debate is a tough one, because the more passive there is, the more you just keep reducing the supply, and that's like a supply shock.
Mark Yusko delves into the impact of the increasing dominance of passive investing in the United States, noting that passive money, index funds, and ETFs now outweighs active investments. He dispels the notion that passive investing is truly passive, highlighting the turnover within indices, albeit at a slower pace. Yusko emphasizes that these funds are capitalization weighted, leading to a concentration in assets as they become more expensive. Drawing parallels to the dot-com bubble of 2000, he warns of potential market irrationality and the dangers of assuming it's different this time, considering the current high valuations of some companies. Yusko discusses the historical turnover of public companies, pointing out that only 31% of those that went public in the last 20 years still exist, indicating the slow but ongoing changes within these indices. He draws attention to the current trend of companies trading at high multiples of earnings and revenues, cautioning against the belief that this time is fundamentally different. Addressing the challenges of shorting in a momentum-driven market, Yusko refers to historical examples such as the difficulty of shorting MicroStrategy in 2000 compared to the more justifiable shorting of overvalued companies. He also touches on the evolving nature of volatility in the cryptocurrency market, particularly in Bitcoin, attributing the decrease in volatility to its maturation, growing market size, and a reduction in leverage and speculation. In summary, Yusko provides insights into the evolving dynamics between passive and active investing, the potential risks associated with concentrated assets and indices, and the changing nature of market volatility, particularly in the cryptocurrency space. Tell us, what do you think of Mark Yusko's thoughts here? Do you see Bitcoin hitting 6 figures this year? Leave a comment below to share your insights. If you found value in the content, hit the like button. Until next time, happy investing.